Hello, my name is Joe Pita, and I spent the majority of the 2012 baseball season in Las Vegas. In fact, I spent so much time in the Strip's finer hotels and buffet lines that I began to muse about things like, if they invented mimosa-flavored toothpaste, I'd totally buy that. I became so accustomed to the ways of Vegas that by the time I came back to San Francisco at the end of the season, if a merchant gave me change and it included a bill that didn't have glitter on it, my first thought was it must be counterfeit. But here's the thing. I wasn't there on a hedonistic bender. Despite being in my 40s, I wasn't going through a midlife crisis. I had the blessing of my wife, who stayed in San Francisco with our 2 young daughters, and I was there at the request of a respected conservative institution in the publishing industry. Plus, I was actually being paid to be there, and it was all because of sports analytics. During my time in Vegas, and I think this is something that every MBA will appreciate, I realized I had stumbled upon a real-life business school case study. And that's why I'm so excited to present my findings to this audience. It's appropriate that this presentation series falls under the heading of Evolution of Sports, because my takeaway from a 2-year immersion in sports analytics isn't a better way to assess the value of a middle reliever or to pass judgment on the 2-5-3 alignment in soccer. No, what I observed is that the evolution of sports analytics places it on the cusp of penetrating a $1 trillion industry. But before I get to that, a little more background is necessary. At the beginning of 2011, I was no one's candidate to lead a discussion on sports analytics at a bar, let alone in Sloan. For 15 years, I'd been trading stocks on Wall Street since getting my MBA at Stanford University. However, in 2011, my trading career came to an abrupt halt. As I crossed the street in Lower Manhattan on foot, an FDNY ambulance plowed into me and I suffered a massive leg injury. Worse, as I lived in San Francisco, I spent the first few months of the year stranded 2,500 miles from my family in a wheelchair as I healed and underwent physical therapy. To pass the time, as spring training began, I threw myself into the baseball season for the first time in many years. Quickly, I started seeing abundant similarities between baseball and the financial industry, between trading stocks and betting on games, and between probability-based decisions made both on the baseball field and the trading floor. And that's when I got an inspiration. My bookshelves are filled with 3 types of books: baseball volumes with a sabermetric bend, Wall Street titles, and Vegas-based books, including tons of poker titles, and they all have one thing in common. They celebrate critical reasoning. Stuck in a wheelchair, I spent nearly every day that spring in 2011 thinking about baseball. It struck me that no one had written a book marrying the topics of sports betting, trading, and sabermetrics. Remember that 80s movie, the cult classic Night Shift? Combining these complementary products into one package seemed as obvious to me as feeding the tuna mayonnaise did to Michael Keaton's Billy Blazkowski. By the time the 2011 season ended, a number of large U.S. publishers saw it the same way, and Penguin Books won an auction for the rights to my book, Trading Bases, a story about Wall Street, gambling, and baseball. I spent the next 6 months writing, and 1 year ago to the day, submitted the final manuscript to the publisher. I thought my job was done and I'd return to the financial industry. What came next, however, was as improbable as landing the book deal in the first place. My editor at Penguin called me and said, "Joe, we love the book. If we gave you the marketing budget for the book, would you consider going to Las Vegas and betting on games for us?" That's like asking a Kardashian if she'd consider making a sex tape. So with the blessing of my wife, I relocated to Las Vegas for the 2012 season. First, however, I knew there was another call I had to make. Within my circle of professional friends and coworkers, I certainly know a bunch of degenerates with addictive personalities, terms I use with nothing but fondness. I knew that if they found out I was going to Vegas to run a fund that did nothing but bet on baseball games, they would want to get in on the action. So, after sending out an email to about 2 dozen close friends, I wasn't surprised that I got a lot of follow-up questions. What I was completely wrong about was the type of questions I got. It turns out that the questions and who asked them should make every MBA passionate about sports analytics think about taking more investment management courses as well. My email got passed around, and before I knew it, I was answering questions from hedge fund managers in New York City, veteran venture capitalists in Silicon Valley, and even a sports talk radio host in San Francisco. It turns out that none of their questions revolved around my thoughts on baseball. Some that wanted to invest didn't even care if they knew what the fund was betting on each night. I thought people would want to invest in the fund for entertainment purposes. Instead, they wanted to know the standard deviation of the daily returns of my fund in 2011, as well as the Sharpe ratio. They were thrilled to find out my returns were model-based. They seemed to crave an investment vehicle that wasn't subject to emotional decision-making by the portfolio manager, and therefore subject to the dreaded style drift, which poisons so many actively managed funds. One recognizable veteran investor in Silicon Valley, after talking to me, said, "Joe, you may have found the holy grail of uncorrelated returns." That quote, reflecting the mindset of one of the savviest investors in Silicon Valley and someone who was responsible for investing hundreds of millions of dollars of institutional assets, made me realize there was a hole to be exploited in the trillion-dollar business of asset management. And it's a hole that can be filled with sports analytics. The very serious and sophisticated queries I received about the fund reflected this and revealed that a high percentage of investors came not from people trying to add entertainment to their life, but those attempting to reduce stock market exposure. With little effort, I had raised $1 million. By the time I set off for Las Vegas, my goal had changed from creating a marketing angle for my publisher to exploring the feasibility of operating a baseball-focused hedge fund, to see on just how large a scale such a fund could operate, and to see if there really was an opportunity to expand an industry. After a season of hotel living, daily exposure to 100-degree heat that turned my arms and legs the color of Sam Adams ale, and using advanced analytics to bet on baseball every day, I concluded there is indeed a huge opportunity to develop this industry, but only if at least one Las Vegas hotel casino changes its operating philosophy and thinks like a visionary. While in Las Vegas, I met and interviewed a number of people from both sides of the counter in the sports betting industry. I found one interview with a bookmaker at a very well-known property especially illuminating. I asked him, "How do you grow your business?" He replied, "Well, we have two customer bases. On one hand, our corporate parent needs us here to give the visitor from, say, Miami, someplace to put $500 on the Dolphins winning the Super Bowl. At the same time, we want to cater to the community of local sports bettors." He proceeded to explain that revenue from the former was dependent on tourism and economic cycles, while the latter's revenue was a function of Las Vegas area population and his book's market share. In doing so, he gave me very detailed statistics on population trends, demographics, and market share on the Strip. It was a very thoughtful, cogent, and impressive answer, if he were a consultant. If he were a visionary, however, he'd be much more interested in my experience because he'd see the potential for a much bigger market than he described. Consider that I effortlessly raised 7 figures, and more importantly, from an industry perspective, turned over the assets of the fund a little more than once a month. Over the course of a baseball season, that's $6 million in handle in one sport from just one person, representing the tip of a potential industry. To the consultant-like thinker, I'd ask, how many new houses need to be built in Las Vegas to create $6 million in baseball handle? Why do I think it's just the tip of an untapped industry? Just look around this facility this weekend. In the words of Eminem, there's a million of us that look like me, who walk, talk, and act like me. And if anyone in the casino business is skeptical of that claim, all they have to do is think back to what happened to their floor space over the last decade. Here's a question for you. Why did thousands of individuals from around the world, including Nate Silver, mind you, quit their jobs and take up poker full-time a decade ago? I think the most common answer I'd get to that is the whole cam, the invention of the whole cam. I would counter that the whole cam was the catalyst for those individuals to take up poker, but the reason they did it was that they realized they had a chance to make a living through critical reasoning. Casinos who tore out slot machines to expand their poker rooms should instantly grasp this. Like the poker migration, there are thousands of like-minded, analytics-obsessed sports fans, many of whom are far smarter than me, who would migrate to Vegas just as surely as I did last summer to run a fund. Only, thanks to the attraction of uncorrelated returns to potential investors, they'd arrive with a lot more than, in the words of Mike McD from Rounders, 3 stacks of high society. Based on my experience, investor demand is there. Just a sliver of the share of investable assets across America that are earmarked for alternative investments could increase the handle at Las Vegas books by multiples. Finally, there are many, many young, intelligent, creative, and investment-savvy individuals who would jump at the chance to run a fund based on advanced analytics. Again, just observe the attendees here. The entire industry of sports analytics is built on the attraction to intellectual exercise, non-obvious, out-of-consensus, data-driven discoveries, and the subsequent exploitation of those inefficiencies. It's the perfect storm of ingredients for the legal bookmaking industry to turn into a profitable souffle. That is, if they make some changes and a visionary organization takes the lead. Here's where thinking like a consultant actually helps. One of the benefits consulting firms bring to their clients is an ability to observe and implement the best practices of other clients in seemingly dissimilar industries. My experience in Las Vegas this summer only strengthened that idea of cross-pollination. One of the things Wall Street does really well is that it thoroughly understands the philosophy, goals, and motivations of its stock trading customers. It's a mandate referred to as Know Your Customer. Salesmen and saleswomen covering a customer make it their jobs to know how much money the customer has under management, whether the customer short stocks, and if the customer adheres to a certain discipline such as value, momentum, or growth investing. By that standard, customer service in Las Vegas is abysmal. In 2012, I made bets every single day in a number of casinos, totaling well over $1 million a month, and not once did anyone at any of these operations proactively ask me a single question about my intentions or how they could get more business. I was needlessly treated like the enemy. 2 decades ago, the most successful Wall Street firms embraced the arrival of the smartest hedge funds, while other banks ran from their business. In Vegas, some hotel casino needs to establish the market for analytics-driven, institutionally managed pools of capital in the sports betting marketplace. They'd become the market leader in a newly created institutional investor market and dominate this potentially huge segment. Here's what I'd do to execute that vision. I'd comb through my customer records and identify any guest who stayed at the property during the Super Bowl, the Final Four, or March Madness weekend, etc., and that also hails from New York, Boston, Chicago, San Francisco, or Los Angeles. In that way, you've likely determined the portion of your customer base that is obsessed with both sports and financial markets. They might also want to immediately exclude anyone who was in Vegas during the first weekend of March. Those people aren't serious about analytics. They should then invite those customers to Las Vegas during a slow time of the year to attend a seminar on hedge fund investing in the world of sports betting. At that seminar, they should invite attorneys, CPAs, bankers, etc., to explain exactly what creating or investing in a hedge fund focus on sports betting entails. Then they should explain to the attendees the services the sportsbook could provide them in the creation, operation, custody of funds, and record keeping of their fund. The last point is key. By facilitating the creation of the industry, a proactive casino would also be in the position to then provide service to these clients. In this sense, it's akin to the extremely lucrative business of prime brokerage on Wall Street, a less heralded but huge, sticky, and far more much stable money-making platform than its better-known trading and research counterparts. Why? Because it's fee-based, and it becomes intertwined with the customer's existence. In the role of prime broker, the book becomes the custodian for these hedge funds' assets. It could keep records, produce K-1s, tax returns, etc., all for a fee, of course. Not only would it reap revenue from this arrangement, but it would then have access to customers' trading records and certainly have the largest share of each customer's business. The sports book would then know the customer to a greater degree than ever before. At the counter, it would then be in a position to proactively match customer orders, bring different customers together with different philosophies, thereby creating the elusive, riskless, and profitable trade for the bookmaker. In the process, management has grafted a fee-based business onto a bookmaking operation, allowing the entity to, in a nod to a Warren Buffett maxim, make 12% lumpy and 8% smooth. The stock trading divisions of investment banks understand that their revenue and profits are tied to 2 factors: the collective amount of assets under management of its customers and how often the customers turn over those assets through trading. Because they have a complete understanding of this, banks devote their existence to attempting to increase both of those items. The cap intro divisions at a bank's sole purpose is to match institutional investors with hedge funds. Their brokers distribute access to customer funds, and an entire sales force is required to call every single customer multiple times each day to tell them what's going on the trading floor. We've got 50,000 Google for sale. We just traded 500,000 Oracle. We're open on the buy side. This drives more trading business. Sports books do none of that. In the past, it's possible, even probable, that such an effort would have been a waste of time. But now, with the possibility to create an entirely new asset class, it's exactly what the visionary sports book should be doing. I can't tell you how much more business one could have done with me by being just a little bit more proactive. Data analysis is so respected right now, so hot a topic, that if you're armed with a model, you can fairly easily find someone to invest in it. I'm living proof of that. The problem now is that outside of the traditional financial industry, there really isn't an outlet big enough to actually reinvest those assets. The huge, massively capitalized corporations who currently run their hotel casinos almost as they run their sports books almost as an afterthought, need to take advantage of their monopoly on sports betting in America and create a home for model builders and the investors they attract. They can create an entirely new niche in the business of asset management and reap the benefits that comes from being a middleman, a seller of picks and axes, if you will, to the spreadsheet-bearing gold seekers who will migrate to Vegas just as they did during the poker boom. All that can happen if they help foster the evolution of the sports analytics industry.
Thanks, Joe. So we have about 5 minutes for questions. Oh, you're always in the back.
Hi, I was just wondering how much research do you do into the online sports wagering world?
Well, I had, as an individual and as a hobbyist, I had a lot of exposure to that. When it came to this project, once I was getting a Penguin, and a large U.S. publisher, and I was actually legitimately raising money from people, this was going to be done in a totally legal way. So that's why the relocation to Vegas, and that's why the establishment, of a Vegas-based, business. I was doing business in Las Vegas and registered with Clark County, et cetera. But from a personal standpoint, yeah, for this, wouldn't be feasible.
Right. Well, I just wanted to let you know, my employer basically runs a sports betting exchange. It's called Matchbook.com. Essentially, it's like the NASDAQ of the sports betting world. And
so is it peer-to-peer?
It's peer-to-peer,
So
yeah.
it's like trade sports or in-trade?
Yeah, exactly. But we focus specifically on the professional gambler. So people who bet, in the $10 to $1 million range per game. So
do you take money from U.S. based accounts anymore?
No, we don't.
Yeah, that's right. That's
so
the thing,
that's kind of the main issue. But I just wanted to get it out there that this does exist on a large scale. It's just not available to American customers. But if anyone's interested, please check out our website.
Thanks for the advertisement.
Thank you. I was just curious if you think there might be any difficulty with convincing sovereign funds, institutional investors, mutual funds that some of their money is tied up in sports bets.
Here's the way I look at that. People that invest in hedge funds or invest in private equity funds, they're sophisticated investors, and by definition, they have to have a large net worth. You can't, you have to be a qualified investor, right? In general, what those people are very good at making money, and they are usually entrepreneurs or they are very rich people, and they either don't have the time or the acumen to invest their money. So when they invest money with a hedge fund, what they are actually telling the hedge fund manager implicitly, if not explicitly, is, Mr. or Mrs. Hedge Fund Manager, please find a way to make an excess return on my capital in any way you see fit. And I've worked at a hedge fund, and I ran a trading desk at a hedge fund for 5 years. My view on the investor mindset is, I don't care if you find a mispriced market in Google stock, sovereign debt of Greece, or the Pittsburgh Pirates' future. If there's an advantage, take proper risk precautions and invest in it. So I do think, and based on the sophisticated people that I talked to, I don't think they had, in fact, they were impressed that there might be something, again, that was uncorrelated to all their other investments, but still offered a positive risk reward.
All right, Joe, we got one last question.
Thank you. It seems to me that sort of a fundamental difference between sports betting and the rest of the securities markets is that if you hold a stock or a bond that has the hope of a return, that's a claim on earnings, and you can be long only. Whereas in the sports betting world, there's another side of the trade, and on the whole, it's not zero sum, it's negative sum because the bookie is taking a cut. So if your vision becomes a reality, then within a very short amount of time, the financial money would swamp the casual tourist bettor money. And if you only have sophisticated investors in this marketplace, or it's 90% of the marketplace, then it's just smart people trading against each other, and the bookie comes out ahead and everyone else comes out behind.
Well, it's a great question. It's a great observation, and I'd look at it two ways. One, you mentioned that sports betting is negative expected value, and I would say so is investing in the sense that there is a commission. Okay, and especially and let's take the derivatives market. The derivatives market is by definition zero sum. Unlike the stock market, I agree with you. That's tied to collective earnings, which should rise by the amount of GDP. So yes. I would also say that even with stocks in the secondary market, okay, the primary market exists as a function to society so that capital can find its way from investors to companies. That does not exist in the sports world. The only possible benefit to society well, it's not possible. The benefit to society that casinos have is simply as entertainment. So yes, there's a vast difference, and something I really go into in the book too, is take pains to explain that. But as far as there's only smart money there, that's still enough for a business, because there are so many different model builders, and they all have such strong opinions. I'm telling you, I could get the head of Fangraphs, Dave Cameron, and the head of Baseball Prospectus, Colin Wires, and I'm telling you, if I get them in the same room and I can keep them separated, I can get them to bet on something. I can get them on opposite sides of a trade, because they're even if all the money is smart money, and it wouldn't all be, but even if it were, they'll be happy to bang heads against each other. And in that way, I think there really are examples of that in the in the financial markets as well. There are certainly pockets, and I really look at the derivatives market as being nothing but it's smart institutional money that goes head to head with each other.
All right, this has been Joe Pita. Go out and buy his book, Trading Bases. Thanks, Joe.